Looking for stock ideas in this crazy market? Well, today we're going to talk about some boring and under the radar stocks to add to your portfolio. Fellow investors, bonjour. This is Mike Leroux, founder of Dividend Stocks Rocks and passionate investor. You're listening to the Dividend Guy blog podcast where I and my co-host Véronique will help you invest with more conviction so you can enjoy your retirement. Investor, bonjour. Mike Leroux here. You're listening to the Dividend Guy podcast. I hope you are doing well today. I am with my co-host Véronique, and we have one of those great episode about a bunch of companies. But what's going to happen today, Véro?
Well, you know what, Mike? I would not like to be called boring. But when it comes to investing, boring is actually sexy because boring stocks are reliable companies you can almost sleep on and still benefit from. So, this is why today we pulled out the best for you, and most of them are under the radar. So, it should be interesting.
It sometimes feels good to have those kind of boring companies in your portfolio where you're thinking, well, it's not growing that fast, but actually it's not going to crash and burn. So it kind of soothe the overall panic around the stock market. And on the fact today, I resisted to talk about those classic companies such as railroads or Fortis, and trying to work a little bit harder to find some companies that we don't talk enough about. So those are not only boring, but they are also flying under the radar.
Before we start, listeners, remember that you should not consider the stocks mentioned in this episode as buy or sell recommendations. You must always do your due diligence. All right, Mike, let's first define a bit more what a boring stock is and what it brings to a portfolio.
So today's episode is really about businesses that are not exciting. Like no hype, no big growth, nothing fancy. So definitely not technology stocks today for sure. But they do the work. There are a lot of things that we need on our day-to-day lives and that those companies are just chugging more and more money every quarter and please a lot of shareholders. So that's the whole point is to have companies that yes will never drive your portfolio double digit, but will likely not be the source of your concerns either.
And should all investors have boring stocks, or are they made for more prudent investors?
Well, in fact, they're not really a different between one company and another, right? If you invest in the stock market, there's nothing safe. Like don't ever think that, oh, I invested in this company, they increased their dividend for the past 50 years, it's 100% safe. Well, VF Corporation actually proved us that they could increase their dividend for the 50th time in a row and then slash it. So nothing is safe. You should not consider that your boring stocks are better than anything else. It's
Mhm.
just that they share a common element. Those businesses are generating repetitive purchases and they're often overlooked. So it's usually a good time when the market goes crazy to derive some of your money into those. But it's really about the repetitive business aspect of it that I found quite interesting.
So, to make things concrete and prove that boring stocks can be of high quality, we've selected the best for you. The first one is an industrial stock part of the software and application industry, so not too far from the technology sector. So, it is automatic data processing, ADP. Why does it fit in the best boring stocks list, Mike?
I mean, they're making paychecks. It's exciting when you get your paycheck and you see the money being deposited in your bank account. But I do remember throwing hundreds of those pay slips in the recycle bin when I was younger. You know, you just get that every 2 weeks. You take the paycheck, you put that in the recycle bin and you don't really care. So one thing that I really enjoy about ADP, and I do have in my portfolio for a few years, actually my biggest regret is not to have it bought 10 years ago. They are offering a small but critical part for each business. I mean, I'm a business owner. I could not live without a paycheck processor. And they're going even beyond that, of course. They offer a lot of HR supports and they're using AI to boost their services. But in the end, it still comes down to, are you able to manage your workforce and pay them with a software? Well, there you go. ADP offers that. And once you find one, I mean, you're going to stick to it for kind of forever, unless it breaks. And ADP being one of the leader in this market, chances are it's not going to break anytime soon. So they're just generating so much recurring revenue. It's just crazy.
And ADP shows a near perfect dividend triangle, but what risks are associated with this company or what makes its bear case?
Of course, there's always a bear case behind any companies, even a solid one like ADP. The first one I can think of is even though it's going to continue to do well during economic slowdowns and recessions, of course, they're going to make less money.
Mm.
If employers are laying off workers, well, that means they are using less the payroll service, and for that reason the revenue and the earnings are going to drop. The other thing that could happen is even though they have a very high barrier to entry in terms of like their stickiness and their great relationship with many major businesses, there are a lot of competition in this case. I mean, they cannot just do their business and nobody will ever realize that it's a great business model. So you have companies like Paychex that are coming after them. You also have like smaller businesses that will focus on better technology to try to disrupt this industry. So you can never just sleep well forever on those businesses. Still requires a minimum of monitoring every quarter.
So the next one I'd like you to discuss, Mike, is another industrial stock, Thomson Reuters, TRI.TO. Why is it boring yet among the best?
Yeah, definitely not an exciting business. Actually, a lot of people could think that Thomson Reuters is all about media because they have like routers, but that's just a very, very tiny portion of their business. Their big business is actually what we call the big three. So they provide information and subscription services to legal professionals, corporates, and tax and accounting professionals. So we're literally talking about like law resources to make some research and stuff like that. Same thing for accounting. So if you get excited by that, I don't know. I mean, some people found accounting like amazing, but just for the story, when I started my bachelor degree in administration, my goal was to become an accountant. That
Mhm.
lasted actually 2 classes. After 2 classes of accounting, I felt like, wow, I don't want to do that for the rest of my life. And then I moved towards marketing and finance, which actually suits a lot more better. So, what I like about Thomson Reuters, though, is they have niched down into highly complex services. So, of course, if you're a lawyer, you need to rely on high quality yet complex information. And this is exactly what they will sell you. Once you subscribe to their services, it's kind of like almost impossible to stop because your business relies on that. Again, you'll see, and this will be like a common theme around most of the business we're going to talk about today. It's a small but critical part of a legal office or an accounting firms. So
Right.
highly repetitive purchases, very sticky business, and very easy for Thomson Reuters to project cash flow moving forward. And this is what makes it such a great business.
And what are the downsides that investors should know about?
Well, the first thing is higher inflation actually in the between 21 and 24 kind of like showed like one of their business model flaw where their multi-year contracts, yes, they included escalators, but not as fast as inflation. So their cost of operation increased faster. This means that also their margin were reduced. So that could be a problem if we enter eventually into a longer period of higher inflation. Not exactly the case right now, but who knows when it's going to come or if it's going to come up next, right? The second thing is, again, similar to ADP. I mean, with the rise of AI, they need to be on top of their game because maybe they're going to find like a new, smaller, more agile services that could come up. And
Mhm.
finally, the thing that like bugs me the most about Thomson Reuters is the growth potential. I mean, it's great to have like a super stable business, but how fast can you grow it once you have those like big accounts with you? So
Mhm.
you're maybe thinking of like a growth potential around like small mid single digit growth rate. So that could be a problem down the road.
All right, so listeners are used to hearing us talk about Canadian banks, but since we go under the radar today, there's another option in the financial worth a spot on this special list. And it is TMX Group X.to. What bull case makes the stock exchange interesting and boring all at once?
And I would argue that Canadian banks are actually quite exciting. So I don't agree with you that they're boring, but that's another story. Here's the thing, stock exchanges, they are all flying under the radar. Of course, today we're going to talk about TMX Group, but we have like also other US stock exchange companies that are selling data and analytics with a similar business
Mhm.
model. They show very strong dividend triangle. So the revenue is increasing year over year, the earnings is following, and the dividend as well. But I don't know, they don't get that much attention. They are all like low yield, high growth stocks. So maybe they are discarded by the dividend community. And on the other side, they may not be as exciting as a tech stock or an asset manager. So that's why
Mhm.
they're not getting that love. But definitely, it's going incredibly well. First, when you run a stock exchange, you make money when people buy and you make money when people sell. So you make money all the time. And even better is you have the ability to sell data analytics to a lot of investment firms. And just to
Right.
give you an idea, I'm spending more than $30,000 a year to run Dividend Stocks Rock just because I need a Refinitiv platform, I need white charts, and I need all of those like financial data so I can provide quality analysis. And I'm just a small business owner. So imagine
Right.
investment firms that have like hundreds of traders and CFAs and analysts. Well, they're all registered to those kind of like services, which cost like so much more money. And funny story, when I started to shop around, I called Bloomberg, I called Refinitiv, and I called FactSet. And the reason why I'm with Refinitiv is the only one that called me back. The others just completely ignored my request, probably because I was just like a very, very small account for them. So just to show you how like they are comfortable with what they're doing, and it's great because once you subscribe to those kind of like models, they will increase their rate every year, similar to Thomson Reuters, and you're kind of like stuck there. And the barrier to entry is huge because you
Mhm.
cannot really copy Toronto Stock Exchange or the New York Stock Exchange. So TMX is running the Toronto Stock Exchange, of course, and 50% of their revenues are recurring. So again, very stable business model. I pretty much love everything around this one.
All right. So now, Mike, what are its potential risks? Because I mean, nothing's perfect, right?
Yeah, it sucks, right? I wish one day we could find like the perfect business model where I have like nothing bad to say about. But knowing the bear case for any of your holdings is like super important. So for TMX, the barrier to entry is really high, but the company could end up competing against US players. And they're a lot bigger than TMX. So
Mm.
that could be a big problem. We see some kind of like interest like coming from NASDAQ, for example, that they see the new Canadian Depository Receipt, the CDRs. So there are like some entries on the Canadian market. So we have to take a look at this. TMX is making money when the market is selling or when the market is buying. But one thing that could hurt is if trading volume goes down. So if there's a moment where it's more stable or after a big market crash, most of the time we're going to see a phenomenon called market fatigue where investors are just like not buying or selling anymore. So lower trading volumes will also hurt revenues and earnings. And finally, TMX must keep on investing all the time to keep that barrier to entry very high. So it requires a lot of investment to keep the technology going, making sure that it's not crashing, making sure that it's not hackable as well, of course. So
Mhm.
it's a capital intensive type of business. And once you get your clients, well, it could be hard to get new ones. So maybe the growth will eventually slow down.
All right, so I can't remember the last time we talked about the next company on the show, which is Fastenal, Fast. Part of the industrial sector, once again, and the distribution industry, Fast has been known for being recession resistant, right, Mike?
Yeah, and I do have a funny story about this one. So my daughter has like some business classes right now. So she's like doing classes before going to university. And in one of her classes, she said, "We have like a conference and someone from Fastenal is going to come to the class to do the conference." And I'm like super excited. I'm like, "Oh, that's so cool. Like it's like actually a trading company. It's a public company." And I start talking about it. And then she's like, "But dad, they're selling like bolts and nuts. Like, what's so interesting about it?" And I'm like, Yeah, yeah, from that point of view, you're right, and unfortunately, the conference was really about what they sell and how they make them, so that was
Mm.
incredibly boring for her, but, like, it was not, of course, about the real business and what they're doing, but anyways, I get passionate about investing, most people don't. I get the point.
We'll
So,
need
yeah,
to
so
invite you over, Mike.
yeah, I would probably make it more interesting. But anyways, so what is great about Fastenal is they have established a very steady and sticky relationship with most of their clients. So they have vending machines, they have vendor on site, they have like their little own boutique of like, yeah, I know I sounded fancy, like it's a boutique of boats and knots, but that's amazing. Imagine that, like you're working like in a manufacturing plant, and then you go into that like small boutique with the like I don't know, like a glass of rosé. Anyways, I'm going somewhere that it's never gonna happen. But yeah, so they are installed inside their customers, so it's great because whenever you need those fasteners, you're not going to order them online. You're not because you need them right away to keep on your
Mm.
production going. So you just go to the on-site stores and you get them. So again, recurring theme here, small but essential piece of business for a lot of industrial companies.
I bet your number one struggle is knowing when and what to sell. And guess what? You're not alone in this. This is why we created a complete webinar on 5 steps to clean your portfolio. You can watch the entire replay for free now at thedividendguyblog.com/webinar. Mike, what will they achieve with the replay?
Well, here's the thing. When you look at your portfolio, you know you should sell a few of your stocks, but you don't want to be wrong. And that is usually the problem. So we hold on to our winners too long, we hold on to our losers too long, and in the end, well, we don't do anything. There's so much information coming in, we don't even know where to start. And this is why I decided to do this webinar to help you invest with more conviction with those 5 easy steps to analyze your portfolio, determine what should stay there and what should get out of it as fast as possible. Once you complete those 5 steps, you're going to have a clean and squeaky portfolio. And on top of that, your confidence in your strategy is going to be a lot better.
Do not wait for your portfolio to be a complete mess. Get it in the shape you want. Visit thedividendguyblog.com/webinar now and watch the free replay.
Selling isn't easy, but I do have tricks to make it better.
And this one also shows a near perfect dividend triangle. So, what would be your bear case for fast?
Yeah, so even though it's recession resistant in a sense where like production must go on even if we are in a recession, an economic slowdown will obviously affect revenues and earnings. So there
Right.
will be some pressure on margins for sure. The other thing that could happen, or actually happening for Fastenal, is their negotiating ability is getting hurt because they're signing up like big national accounts. And of course, those guys, they buy a lot and they want to bring the price down. So the margins are under pressure. And while the revenues are increasing, the earnings may increase like slower. So when you look at the dividend triangle, this is a good sign. When you see the trend of the revenues like going up, let's say for 10% per year, but then the earnings per share are going up by like 5% or 6%, well, then you know that the company struggles to maintain the same margin. So it's harder for them, even if they're selling more, to keep up with the same level of profit. So it's not a catastrophic thing, but it's still a red flag to monitor over time because at one point, maybe you're going to have like a flat line of earnings and then revenues that are still increasing, but at a slower pace. And then
Mhm.
you could come into problems. So with Fastenal, it's not the case right now, but it's still something that you have to keep in mind at this point.
So the next one is probably one of the best examples of a boring yet amazing stock, and it is Waste Connections, WCN.TO. Tell us more about it, Mike.
Yeah, so Waste Connection, one of my most recent purchase earlier this year. This company trades on both Canadian and US markets. Actually, it's even
Mhm.
more a US company than a Canadian one these days because they grow by acquisition and they grew a lot faster in the US. So they're doing waste collection, disposal, recycling services. And I must admit, I run every morning. And whenever there's a truck that passed by me during my morning run and it's a Waste Connection one in my neighborhood, I just can't help it to smile. I mean, it's just like a good reminder. It's like, oh yeah, they have to take care of like all the waste in my neighborhood, and that's never going to change. They have like super long-term contract. It's recurring. They increase their price over time. So super easy for them to maintain their business and increasing it. And even better, super high barrier to entry on one side, landfill scarcity. So it's super hard to say, oh yeah, we're going to like open new landfill places.
Right.
So once Waste Connection as one established, like the regulators are not necessarily going to open up for new competitors either.
Mhm.
So very sticky business. Again, small portion of our life, but so essential. I mean, cannot really live. I mean, I miss the day, like the waste day during the holidays last year. And we were just like literally counting how many bags we could fit in our trash can. And at one point, it started to get like, we were like counting the days before the next truck would pass by. So sometimes, little things that show you the importance of a business.
Well, I have to add something about that because my husband is like the expert of knowing which container to use in the city when it doesn't happen often. I must like don't go after him, but sometimes like during Christmas, during holidays, when our garbage bin or recycle bin are full, he knows which container he can use without getting like caught doing
A
this.
man of experience.
Yes. And it's fascinating. I mean, we used to live somewhere else and it was the same thing. Like he knows by heart on this street, this container is for recycling. On this street, this container. And I'm like, anyway, just I thought it was very funny.
Indeed.
So Mike, Waste Connections must probably have those bins also, but it has a wide moat, but it doesn't mean it doesn't have downsides. So what are they?
The biggest one is definitely the price you have to pay to buy this one. The PE ratio is crazy. It's about 50 times its earnings most of the time. And it goes with the good old saying you have to pay for quality. Such a steady business. I've been looking at Waste Connection for years. And every single time I was like, yeah, it's expensive. And then 5 years later, it's just expensive. And then another
Right.
5 years, it's still expensive. So, I finally did it, but I did that like several times, like buying Visa like 8 years ago. Just bite the bullet, go for it, and there you go. But it's still price is crazy. I'm never going to argue with any investors if they're telling me I'm not going to put my money on such a high P ratio. I cannot argue with that. Other thing is, since they're heavy on acquisition and that's the bulk of their growth, of course, well, there are always debt and integration risks and maybe a limit of acquisition they can make going forward. So that's another downside. And finally, most cities are trying to reduce waste. So, and kind of like waste management as to waste connection, sorry, thinking of like a competitor right now, they must help like cities to do that. But when they do this, well, they're actually making less money because they're paid to take care of waste. But
Right.
that is also something that could hurt the growth of the business moving forward.
All right, so in the consumer staples sector, we can think of McCormick MKC as one of the best under the radar yet boring stocks. What's your bull case for MKC?
You know, I'm disappointed because I do private webinars for the DSR members every single month
Hmm.
since 2020. So it's been 5 years. And I'm not even sure I received one question about McCormick during 5 years.
It's true,
And I
right?
mean, of course, they're selling spices and seasonings. So, I mean, unless you're big on cooking, it's definitely not exciting. I totally get that. But this business is kind of like a hidden gem. They're investing more than their peers in marketing and research and development. And they have like a large share of like a multi-billion-dollar market. They're using their cash flow because, of course, I mean, seasoning, it's repetitive purchases all the time. So they get that cash flow, they invest all the time into those like this matcher business to create innovation or to make acquisition as well. So they make new products, they push their sales, and the more products they have and the more their marketing is good, well, the more shelf space they have. And shelf space in a grocery store is everything. So
Mhm.
McCormick definitely knows how to run their playbook.
So, what can negatively impact its business?
Well, of course, I mean, there's a limit of spices you can put in a soup. So
Right.
you
You
cannot
keep
grow
repeating
that
that.
fast. Yeah, I keep saying that when we talk about duplicates, right? You cannot put seven different kind of salts in your soup. Well, that's pretty much a good rule also for McCormick. So it's not a fast growing business. And the problem with not fast growing business is sometimes their margin will go under pressure. They have to negotiate with big accounts like companies like Walmart's, Kroger's, and the likes. So, of course, those guys, they do have a lot of negotiating power versus like a Seasons and Spice company, especially because they want to negotiate to get like bigger and larger shelf space. So, a margin under pressure, weak revenue growth could be the two biggest headwinds for McCormick going forward.
Now, Hydro 1H.to may seem boring, but I mean, it's performing well in the utilities. So, what would be your bull case?
So, super stable. 99% of their business is regulated by the government of Ontario, and even the government of Ontario like owns a good part of it. So, super stable. They know exactly how to run their playbook. So, they have like capital expenditure of like 1.3 to 1.6 billion per year throughout 2027. And then what they do is they simply increase their rate with the regulators. So they have that good relationship. They use that playbook, expected EPS to grow between 6 to 8% annually in the next 3 years. They operate in a monopoly situation because they have just to deal with the regulators. So super easy for them to predict their cash flow, have their projects in, and know exactly how and when they will increase their rate. They also, even better, because they count on renewable energy with hydroelectricity, which is also a very good thing moving forward because it's a lot easier to renew that energy versus any other else.
But Mike, we won't discuss politics here, but I have to ask, knowing that Doug Ford, Prime Minister of Ontario, is like threatening the US to stop giving them electricity. How would you describe like the barricades for Hydron and is it part of that?
Yeah, definitely. I mean, that's a problem, right? They own a big chunk of Hydro One, and I mean, the government can decide whatever they want in a sense. And the commercial war, and keep in mind, we're recording this a few weeks like ahead, and like
It can
tariffs and
change, of
commercial
course.
wars and news are literally changing every 15 minutes. So whatever happened over the past 2 weeks, I don't know. And but more will come anyway. So definitely a lot of uncertainties around that. The other thing I don't like actually is the fact that they're super heavy dependent on Ontario's economy. So on the one side, it's great because Ontario has like is a very well diversified province in terms of their economy, but being dependent on a single province or on the US on the same time on a single state is always a problem. We saw that with Alberta several years ago when there was an oil bust. A lot of utility companies had a hard time. So same thing with Ontario. So if we have like more head-to-head fight with the US, that could lead to a stronger recession in Ontario than other provinces. And then, of course, well, it also means less revenue and less earnings for Hydro One. The other thing is, even though they are very strong at managing their business playbook, they raise their capital expenditure, they spend money, and then they increase their rate. Well, that also includes some debt growing to finance the growth potential. So this creating this balance between how much you pay in interest charges versus how much you generate in the future. If we go into a recession, that could also be a burden at one point for the company.
All right, so let's end with another industrial stock, Mike. AO Smith, AOS. Why is it part of this list?
Well, this one dominates the market for water eaters in the US and Chinese markets. And how many times have you told like people that come in say, "Hey, Mike, go and see in my basement. I have a new water heater," right? Well, there you go. So
Never.
they're making water heaters, boilers, tanks, and water treatment products, like all the things that it sucks to pay when they're up for renewal, like when they're not of good use and you need to repair them. That's about it, right? So again,
Mhm.
small but crucial part of any properties because I mean,
Right.
we all love a good warm shower. So there's a lot of money being invested in those products. It goes along with construction as well. So being dominant in the US makes them enabled to have like better margin and they have like a lot of growth vectors in China and India as well.
And what are the reasons not to buy it?
Well, the stock price got hit as of late, of course, because of tariffs and commercial wars with China. So, definitely bad. If you remember back in 2018, when we had the first tariff war between US and China,
Mhm.
it was also a tough place to be for AO Smith. And that's going to be tough going forward as well. The margins are thinner outside of the US. So, if you add tariffs on that too, it's going to be tough for them to count on China and other countries as a growth vector. So that's definitely a threat. And of course, since they are quite tied to the construction market, and any economic slowdown or recession would also affect AOS. So this one seems a little bit riskier right now due to the level of uncertainty, but at the same time could probably be one of the best opportunity there is in this market.
Mike, we have seen many picks in the industrial sector. So my question is it possible to build a portfolio with only like those of the best boring stocks? I mean, it's a tempting idea, right?
Well, it's a tempting idea, but as I said in the introduction, I don't think it's enough. Like it's one characteristic, and of course, we have decided to ignore companies like Fortis and Canadian National Railway. On the US side, we could have talked about all the consumer products such as like Procter and Gamble, Colgate
Right.
Palmolive, Clorox, Coca-Cola. All of those companies are not really exciting, and yet they are chugging money all the time. But you need more than this. It's just like an angle. And after all, some boring companies are not doing that great too. I can think of like Transcontinental in the printing media business.
Hmm.
BCE, nothing fancy and exciting about this one. B&G Foods and Macy's on the US side. So there are a lot of like boring companies that actually are just struggling, and mature businesses that are going nowhere. And even when I said about AO Smith, this one still is under a lot of pressure right now. So focusing on those boring and steady heady businesses, it's just a good angle on one side to make you feel good about your portfolio, but
Hmm.
you need to dig a little bit further. You need to have like strong financial metrics, you need to have like a good investment thesis, and of course, what is great about those companies, I would say, is really the fact that they are a small but a critical part of either our daily lives or for a business to function. The key here is by being small, they're going to be less affected by a recession because and by being critical, well, businesses will have no other choice but to keep on buying those products or those services. I mean, even if I see sales going down at dividend stocks rock by 20% in a year because we're in a deep recession, I have no other choice but to still issue your paycheck, right? I mean, that's the point. So I will still have to deal with my payroll processor. That's the norm. So that's a good way to see how you can feel good about those businesses. But again, it's not because they show repetitive purchases in a sticky business model that they're completely recession proof and that they will be thriving going forward.
Mike, your thoughts make me think about our most recent webinar on steps to clean your portfolio. So if you have missed it, listeners, I invite you to join the free replay now at thedividendguyblog.com/webinar. Well, thank you so much, Mike, for these amazing, boring, and under the radar stocks. It's surely a good place to look into. Listeners, make sure to avoid a messy portfolio by watching our webinar replay free now at thedividendguyblog.com/webinar. For the show notes and related content, visit thedividendguyblog.com/220. Next week, we will share the characteristics of a Trump proof portfolio. Read uncertainties proof portfolio, right? Hit the subscribe button underneath our podcast logo now so as not to miss it. Until then, stay invested.
Stay invested. Hey, fellow investors, it's Mike here. I hope that you have enjoyed this episode. Please note that the Dividend Guy blog podcast is at no time issuing buy or sell recommendation. Please do your own due diligence as this podcast is recorded for information and hopefully fun purposes only. Make your research, make sure you do your stuff. We're not responsible for your losses or your profit after listening to this episode. And until next one, stay invested.